Welcome, Deep Diver. Today, we're plunging into the fascinating world of Netflix Inc.,
Right.
a company that's really, mastered transformation.
Yeah,
DVDs by mail to this global streaming giant.
absolutely.
Our mission today, to really pull out the vital insights from our sources on its finances, its strategy, and, well, what it all means for your understanding of today's market.
Exactly. We'll trace that journey, maybe focus a bit on the last decade or so, because
Yeah.
there are some genuinely surprising financial shifts
Yeah.
and some big strategic challenges they're tackling right now.
Right, let's start there.
Yeah.
This story of reinvention. It's amazing to think it started way back 1997. Reed Hastings, late fees, the famous origin story.
Yeah.
But it wasn't just like one flip to streaming, was it? It feels much more like constant adaptation.
That's precisely it. It's been continuous. And the biggest, maybe the most significant aha moment financially, it's their recent shift
Okay.
to consistently strong, positive, free cash flow, FCF.
Right, FCF. That's huge for them, isn't
Yeah.
it? After years of hearing about their debt for content.
Huge is the word. For years, it was all about burning cash, taking on debt for shows and movies. But now, in 2023, they generated $7.27 billion in free cash flow.
Wow.
And they're projecting over $9 billion in 2025. So what this means is they're actually self-funding their content now.
Self-funding.
And even buying back shares. It's a massive turnaround, a whole new level of financial maturity, you could say.
That really is an incredible pivot. So how do they actually pull that off, going from, debt-fueled growth to generating that kind of cash?
Well, our sources point to two big recent strategies. First, the ad-supported tier.
Yes, the ads.
By May 2025, that had 94 million monthly active users.
94 million.
Yeah, and it accounted for something like 40% of new signups where it's available. That's a serious new revenue stream they just switched on.
Okay, that's one. What's the other?
The second one, the crackdown on password sharing. Remember all the noise about that?
Oh, yeah, definitely. Did it work?
It seems so. It generated about 9.33 million new subscribers. And get this, daily signups in the U.S. apparently jumped 102% right after they implemented it.
Wow, 100% jump. So these moves, it sounds like a real strategy shift.
Exactly. It signals they're moving beyond just chasing subscriber numbers.
Yeah.
Now it's about maximizing revenue per user, especially since growth is slowing down in places like the U.S. and Canada.
Which have the highest revenue per user already, right? The ARPU.
That's right. The highest ARPU, around $17.17. So they need to get more from the users they have in those areas.
Makes sense. But okay, even with this financial strength, they're still spending enormous amounts on content, right? That hasn't changed.
Oh, absolutely not. They need to. We're talking over $25 billion projected for content spending in 2025.
25 billion.
It sounds like a lot, and it is, but it's fundamental. That's how they differentiate themselves in what's become a super competitive global market. It keeps people subscribed and attracts new ones.
So the cash flow supports the content spend, which drives the business.
Precisely. But here's where things get, well, really interesting for investors, maybe. The valuation question.
The price tag.
Yeah. Despite all these operational strengths, this amazing financial turnaround, if you look at it through a traditional value investing lens, like Benjamin Graham's principles,
Okay.
Netflix, with its price-to-earnings ratio, its PE, up around 48, maybe 49.
Pretty high.
It's high. It means the stock price is almost 50 times its annual earnings per share. Yeah. So from that conservative viewpoint, it would likely be seen as, well, significantly overvalued at its current price.
So the value isn't based on current earnings, but future potential.
Exactly. It's driven almost entirely by expectations of future growth, future innovation, not really a discounted value of what it has today.
Okay, so wrapping this up then, you, the listener, we lead Netflix, a company that's clearly shown it can adapt. It's financially strong now, but its stock valuation is, well, a hot topic, a real point of debate.
Which really leads to a bigger question for you to think about. In this digital economy where things change so fast, where so much value is tied up in, future ideas, content libraries, intangible stuff.
Yeah.
How should you actually assess a company's true value? Is a classic PE ratio still the best tool, or do we need different ways to measure value when it's all about innovation?
Something to definitely ponder next time you're scrolling through trying to find something to watch.